Hi, today I want to talk to you about seller financing, which has few other names, but I'm talking about seller financing and how it relates to a real estate transaction. This could also be called a seller carryback, where a seller will hold a note, seller will carry a loan, seller will hold a mortgage, that kind of thing. But basically what it is when the seller or the owner of a property acts like the bank and holds the note for the buyer for a specified amount of time. Typically, a seller carryback will come due in 1 to 5 years of starting the loan. That would be because sellers don't really want to do, or most of them don't really want to hold a note, but they do it for a couple of years so that the buyer can get it together. They could sell the lot quickly, and then in 2 years or so, when the balance is due, the buyer will pay off the note and the seller can go on its way, rather than having the property sit on the market for too long. And then of course, the longer a property is on the market, the harder it is for them to sell, because buyers think, why has this been for sale for 2 years? Even though there may be really good reasons for it. So I am going to give you later on in this video an example using some numbers so that you can kind of understand how it works. But first, I want you to know when this is likely to happen. So the most common time you will see a seller carryback will be in a land purchase, and that's because banks and finance company, mortgage companies don't really like to lend on raw land. It's a little riskier for them and they don't want to do it. You can find banks that will do it, but it's a little harder. So that's one reason. Another is if it's a buyer's market, and a buyer's market is basically when you have more properties for sale then there are buyers who are willing and able to pay for the property. And sometimes a seller will hold a note on a house, a condo, a piece of land just to get it sold. And that will give the buyer a couple years to get it together and pay off the loan where everybody could move on. Another case you might commonly see it would be in a manufactured home, or actually it would be called a mobile home that is built, constructed before 1976. And the reason this is because in 1976, the government came out with a bunch of standards for the construction of these homes, and now they're called manufactured homes. So homes built prior to 1976 are called mobile homes. Anything later than 1976 are manufactured homes, because they are going by these guidelines for safety, which would be like a more pitched roof, maybe better construction materials. And then the banks will recognize that as a solid home and they're willing to loan on them. Not all banks, but quite a few more than anything that was built prior to 1976. So there's where you would find an example. And one last example is if you have a very investment savvy seller who knows that he or she could get a better return on their investment, return on their money, than they could elsewhere. Typically elsewhere would be the stock market, but not always. And sometimes, even though a seller could get an equally good investment in the stock market, they would still hold a note because they want to diversify, not have all their money in one place. So in this transaction, say you see a piece of land in Flagstaff that you want, and there's a sign that says seller will carry. This is how it would work. You would have your buyer's agent, someone like me, write up the standard purchase contract to give to the seller, and along with that there would be a seller carryback addendum, and that is where you put out all the terms of the loan. Typically the seller is going to dictate the terms of the loan, so you're going to most likely have a higher down payment than normal. So you could have anywhere from 20% to 50% down payment. So the example I'm going to use is a lot in Flagstaff for sale for $100,000. So the seller would say, I want 30% down. So that comes out to $30,000. Now the seller will carry a note of $70,000. Say he or she says, I want the full amount due in 2 years. So that means in 2 years, they have what is called a balloon payment, and a balloon payment basically is the balance of the loan after a certain amount of time has passed. But in order to calculate your principal and interest payments, you're going to need some other things. You're going to see how many years is the loan amortized over. So 15 years to 30 years is a common example. So say seller wants it amortized over 15 years and wants 6, maybe 5% interest. He's being generous. The reason I say 5% is they're going to get a little more than the going rate, which is about 3% right now. And those are the things that you would need to calculate your P&I, principal and interest. Now, okay, so the terms that we just talked about are going to be used to calculate the principal and interest, and that's the amount we're going to put on the seller carryback addendum form. But the way you come up with that is you're probably going to just download a financial calculator off of your Apple store or your Android store. You could also use a financial calendar. In the old days, when I took accounting and finance back in college, we used to have amortization tables, which were like a little booklet this thick of the tables, and you would have to look up this information. But today, you download a mortgage calculator, you type in sale $100,000, and the reason I say that is, please, if you are asking a seller to carry your mortgage, do not lowball an offer for the property. Give him very close to full asking price. So you're going to have, and you can type this in your mortgage calculator, sale price $100,000, down payment $30,000, which means your loan amount is $70,000. In the same app, you're going to input 5% interest, 15 years amortization. So that will come back with an amount of, let me see, a monthly amount of $554. Now, you as a buyer are going to pay a little bit more than $554 because I recommend any seller and even buyer who is doing this, do not work this out between each other and buyer pay seller directly. What you want to do is have a third party administer this or service the loan. The third party is typically a title company. They usually charge about $30 a month to service it. And they also take a little bit out each month, maybe 30 more, and they put it into an escrow account so that when tax time comes, title company, pays the taxes, and you never have a piece of land or property taken away by the government because somebody didn't pay their property tax. So do that. The other thing is, as a buyer, if you stop paying, that seller's going to start foreclosing, and they can foreclose on your property the same way that a bank can. So don't think, ooh, I'm going to get away with this. You can get foreclosed on if you don't make your payment or you don't come up with the balloon payment at the end of the 2 years, whatever term you specified the entire amount was due. So you're going to have $554 plus whatever servicing fee. So in this example, you're paying $600 a month for 2 years, and at the end of the 2 years, you got to be expecting that the whole thing is come due. So you'll take your little amortization calculator you just worked out, and you're going to hit something that says schedule, a button that says schedule, and you're going to scroll down to the table where it says 24, because that means 24 payments have been made, and then you'll slide over and it will say balance due. Well, in this point, I think it's $63,404 is due. And now that means you, buyer, have to pay seller $63,400 something thousand in cash. Now, how's this going to happen? You're going to either have the cash because, hey, you had a good business deal, you had an inheritance, you sold your house that was for sale. That's one way to pay it off. Another is you just get another loan somehow. You knew that you would have better credit, say, and you have a better loan. You pay the seller off with that. The other thing is if you sell your property, say you bought it to fix it up and sell it, and after a year and a half, it was sold, and that's when you pay. So you pay it early. Okay, so there's one more situation where you could pay off your amount. Is say you bought raw land, and in 2 years, now you're ready to build. You come up with that construction loan. Basically, a construction loan is higher than the land amount, and it's about what you expect a construction project will cost. You have to have your plans and everything, quote, by your general contractor, and then you get a loan, you build the property. At the end of the building process, when your project has passed inspection, then you get an actual 30-year mortgage, 15-year mortgage from a mortgage company. You pay off your construction loan. So that is it. My example of how to explain seller carryback in as easy terms as I can come up with. Now, I want you to know I am not a financial expert, do not have a financing degree, but I do have an MBA. I took a lot of these classes in school. If you really want to know a lot, I'd put you in touch with a mortgage broker. But that's it. Seller carryback explained. My name's Dawn Dickenson. I live here in beautiful Sedona. I love it when people call and say, hey, I saw your video. I have a question. Text me if you want to do that. Write a comment below. If you like the video, please subscribe. Put a thumbs up. It helps other people looking on this topic to find the video. And if you ever have a real estate question, again, contact me. My information is below. I publish content on Northern Arizona real estate type topics every single week. So I hope to see you back here again next week, usually Thursday or Friday. And hope everyone has a fun and safe weekend. And if you are in Arizona, any place, just try to stay cool.